Welcome to a special presentation sponsored by Corum Group.
Hello, everyone. Today we're going to be talking about succession and estate planning to maximize your wealth. If you've been to Corum's many educational events, you know how much we stress preparation in order to achieve an optimal outcome. It's critical that you understand your succession options and the best way to structure your estate. Unfortunately, too many estate planners do not understand the unique aspects of a software business based on intangible assets. Let me start by asking you, what do you do when most of your wealth is tied up in your company? What is your succession plan? What are the ways you can step away from your business, retire, move on to other opportunities without losing the value you've worked so hard to build, to live the life you've dreamed? First off, you might be surprised how limited your succession options are because of the unique and tangible nature of our industry, the complexity of our business based on intellectual property instead of hard assets, and the extraordinary values unlike any other business. Because of this, there's a lack of traditional bank financing, which are used in traditional succession planning. Let me explain. We need to start by first understanding the economics of our industry relative to traditional industries. This chart, which I first developed for our Selling Up, Selling Out conference, shows why some of the greatest wealth in history has been made in technology. Unlike traditional companies, software business is at the increment, meaning the next unit you sell, is nearly all profit. What this means is that the valuation is vastly different than traditional industries, not dependent on balance sheet or even current earnings. A traditional business sells for about 0.6 times revenue. It's not unusual to see the same size software company sell for 6 times revenue, 10 times more valuable. Yet the software company probably has a smaller balance sheet and might even be running at a loss. Just take a look at this chart comparing traditional versus tech companies in the same basic fields to underscore this point. We picked some industries that are representative: AEC, travel and leisure, HR, and MarTech. Software-based companies versus non-tech firms in the same sector. For AEC, we picked Autodesk versus ICOM. Autodesk is at 9.1 times revenue, ICOM 1 times revenue. Travel and leisure, Booking.com versus TUI, 4.3 versus 0.6. Human resources, look at Paycom at 13.9 versus Randstad at 0.4. Wow, what a difference. And in marketing, HubSpot versus Omicron Group, 8 times sales versus 1.3. Extraordinary differences. This radical difference will affect your succession options and your estate planning, as we'll see. So back to succession planning. What exactly are your succession planning options? Here's your list. First, pass it on to your kids. MBO, management buyout. ESOP, employee stock option programs. IPO, initial public offering. SPACs, or merger, sale, or recapitalization. So what do you think of when you think of the word succession? Does it immediately conjure up your kids taking over your technology business? So that's why it's the first on our list. What do you think about your children taking over? Likely to happen? I have a lot of family businesses these days, as exemplified by this Chicago Tribune headline. The boss is retiring. The kids don't want the business. It's all too often the case. How do you feel about that? Or how about this picture of the kids absorbed in their phones? It's hard to imagine these two empire builders taking over. You're more likely to hear, "Dad, we love you, and we're proud of you, and we've seen how incredibly hard you work. We'll pass on the business. Can you just give us a check?" And you know I'm not kidding with that. And it gets worse. Less than 1% of companies are passed on to their grandchildren in tech. So that pretty much rules out passing the company to your children for most of you. What about the next two, MBOs or ESOPs? In most traditional company buyouts or sales, the bank plays a key role through loans on hard assets of the business, plant, equipment, inventories, etc. Not so with software companies, as the assets are intangible. Further, traditional companies are somewhat steady state, can be bought by almost anyone. They're usually sold locally, which is a comfort to the banks. Tech companies, on the other hand, are constantly changing and sold only to other tech companies, which can be anywhere in the world. So without bank financing, management buyouts are seldom done. And ESOPs, let's face it, unless you're going to give the company to your employees, they just can't afford to buy you. They can't compete with the public buyers or private equity firms who are paying record prices, so we can rule out that option. IPOs, well, they've been shut down recently, so that option is off the table for now. SPACs, which were all the rage during the pandemic, are going away due to regulatory compliance. So that leaves merger, sale, or recapitalization. By the way, before I go further, I would encourage you to attend our merge briefing or Selling Up, Selling Out conference, the Tech M&A Bootcamp that is the most attended executive conference in the history of the tech industry. Now, there's some good news. While IPOs and SPACs are shut down, tech M&A is experiencing record volume. Now, let's look at estate taxes and maximizing your wealth. I'd tell you a story. I was writing the script up on Whidbey Island where my grandchildren live. My oldest grandson, who is still young, was having trouble with my explanation of the estate tax problem. So I said, "Hey, let's play a game." And he said, "Good, I like games." I wanted to show him the impact of these taxes. So I pulled out 10 $1 bills, holding it in my hand. I explained that this would be the money I just earned, and my goal is to get it to you eventually. I'll tell you what, why don't I just give it to you right now? Pretend it's yours. He took the money and smiled. Then I'll take taxes from you, pretending I'm the government. Slowly, I went through the taxes, explaining what they were: income tax, special assessments, then estate taxes, both federal and state. Quickly, my grandson was down to a few dollars. He didn't like me taking his money. He took it personally. He got up and threw what he had left to me and said, "I don't like this game." I told him, none of us likes this game. But like it or not, what can we do? Well, there are a few things we can do. Looking ahead to 2023, we polled our legal advisors and tax advisors who are sponsors of Corum's events. Here are 5 things they came up with. Number 1, time your exit to minimize capital gains. Can you sell this year? Number 2, accelerate earnings into the current period. That seems obvious. Be taxed when it's a lower tax rate. Number 3, look at deferral mechanisms when your rates will be lower. For example, earnouts or bonuses, particularly if you're structuring a deal where you might be older at a lower rate. Number 4, start gifting while exemptions are high. And the last one, look at generation skipping trusts, GST, to avoid estate taxes. The gift and estate tax exemptions have increased for 2023. You'll be able to give away $17,000 a year to any person you like. So for married couples, that's $34,000 a year. It's great to help somebody who's unemployed, a family member who's struggling, school costs, new baby, whatever, as the money you give them is not taxable because you've already paid taxes. You can also do larger gifts to get funds to your heirs to help them buy a home, make a down payment on a business, whatever. It can be for much larger chunks up to the current lifetime exemption level. In 2023, it's set at $12.92 million. So for married couples, that's $25.84 million. For couples that have already maxed out their lifetime gift exemption, they will be able to gift an additional $1.72 million in 2023 due to inflation adjustment. Now, any amount below that exemption will not be subject to federal estate tax. However, once you have assets above that amount, you'll pay up to 40%. You want to take advantage of this limit because in 2025, the exemption will drop to pre-2018 levels of only $5 million, adjusted for inflation. The advantage of these larger gifts is that you can really change the arc of someone's life. Watch them use the money now instead of later. Boy, I'll tell you, it's very rewarding if you do this. In addition, in the U.S., some states have their own estate tax, which will be paid on top of the 40%. Now, most people don't exceed the lifetime gift exemption, but often make larger gifts during their lives when a company is lower in value or maybe take discounts to that value in order to transfer assets at a lower rate to descendants and let those assets depreciate in the descendant's name. Most people will transfer their assets into what is called an irrevocable trust or a generation skipping trust or GST. This is for the benefit of their descendants, and the trust can pass on for many, many generations depending on how it's structured. And this will avoid estate tax in the future, so it can be a highly beneficial planning tool. Look, for most of you, your company is your biggest asset, representing years, if not decades, of investment. I know it was that way for me when I built my software company. Technology company owners have an advantage when it comes to transferring a lower value asset into these trusts. The reason is that you can legally use traditional non-tech business valuations to value the stock of a privately held tech company. So you remember those couple of slides where we talked about software companies relative to traditional companies and the difference in valuation? Okay. You can use a lower valuation to transfer into the generation skipping trust, and it's totally legal. So let's go into an example. Let's say your tech company with minimum assets might be valued at only $5 million by traditional methodologies, which are often asset-based. But you might sell it for $50 million using the valuations we use in our transactions. Now, you'll only be taxed on the amount that's not in the trust. The remainder in the trust is not subject to taxation. That means that a stock in the trust does not have to pay estate taxes. That's how you transfer wealth to your children, grandchildren, etc. Now, a little bit about how you do this. First, you have to get a traditional valuation for your company. There are accounting firms that are qualified to do this, but they don't use the same methods we use. They use book value, excess earnings, lower multiple asset values, and the like. Then you transfer the stock into an irrevocable trust at the lower valuation, the valuation they came up with. You want to keep that report, by the way. Later, you'll sell your technology company at a much higher valuation, but the valuation inside the trust is set at that point. The result is that the stock and trust is worth a lot more based on the higher valuation that you just got. But you do not have to pay estate taxes for the stock that's in the trust. It's all totally legal. If you're considering this route, there's a couple things you must do. Each situation has to be reviewed by competent estate, tax planning attorneys, and accountants. And you'll have to report any gifts for tax purposes on your annual tax report. As I said, you're going to need an evaluation. You can't just go back and say, well, I thought it was worth this. You have to have a formal valuation from a qualified, authorized valuator. You need to consult with competent legal and accounting counsel. Getting these valuations is not easy. First, you have to understand that you're going to have to go through a process, create competitive tension, which creates your auction environment. To best explain how to do this, I encourage you to view the 4 short videos on the landing page of Corum's website on maximizing value, www.corumgroup.com.